Let's get started. I think we have a number of you sort of dialed in already. Warm welcome to the iSTOX, from the iSTOX family, to all of you to join us today. Today our topic is the future of private market unicorns in a post-pandemic world. This is part of iSTOX series of fireside chats, which will touch on the spectrum of topics, ranging from technology to investing, all designed to keep investors and participants like yourselves informed about everything you need to know in today's changing world. iSTOX is the first regulated capital markets platform that uses securities digitization to open up the private capital markets to investors. I'm Oyi, the Chief Commercial Officer of iSTOX, and we have worked very closely with our partners at Smart Karma and 01 to bring to you, our community, research and insights into the world of unicorns. And we have a report that accompanies this presentation, which will be available shortly on our website. And at the end of this presentation, I will give you an email that you can write to if you're interested in that report. Our speaker tonight is Vincent Fernando from 01. 01 is a tech specialist investment research and corporate finance advisory covering listed and private technology companies in both Asia and the US. 01 is regularly published across Bloomberg, Smart Karma, and Tech in Asia. And here with us tonight is Vincent Fernando. He has more than 15 years of investment research and capital raising experience, working at both boutique firms and larger investment banks such as Citi and Macquarie. He has traveled extensively in his career throughout Asia. Oh, I'm sorry, I forgot to go through my slides. He has traveled extensively during his career, having been based in New York, Hong Kong, Thailand, and finally Singapore, where he was Director of Equity Research covering Southeast Asia, where he originated and marketed multiple investment banking deals. Now, before I let Vincent start on his presentation about unicorns, if you have any questions along the way, enter them into the Q&A button below, and we will have some time for Q&A after the presentation. Just click on the Q&A button, which is represented by two speech bubbles right at the bottom of the Zoom screen. If you don't see it, just move your cursor down and it will display. We will then sort of go through your Q&A at the end of the session. And right now, I shall pass over the mic to Vincent.
Yeah, thanks you for introducing me. 1 second, so I'll go and share my screen. Okay, so just before we'll get the legal stuff out of the way, this is just a quick disclaimer. Obviously, this isn't any offer for any securities. It's for general information purpose only. We're just talking about industry and industry trends, and there's no recommendation of any of the companies in here. So, what are we talking about here? We're talking about the future of private market unicorns in post-pandemic world. First, just want to add, kind of add some color here. Private equity in the last 10 years has actually outperformed public equity by a pretty wide margin. So from March 2010, 2020, private equity returns have actually been, 13.2% a year. And that's compared to 6.6% a year for public equities. And they've outperformed a lot of other asset classes. Now, when you think about it on a compound basis, this difference in performance has actually resulted in a 246% cumulative compound return over 10 years, where it's 89% public equity. So private equity has done really well in the last 10 years. Now, one of the reasons is that we've had so many unicorn companies created in the last 10 years. And these are basically companies that exceed $1 billion and are private companies, and which is it's a very, let's say, newer phenomenon. Before things would IPO much earlier. So let's just look at Uber for a little bit. I think this is a great example of how value can be created in the private market. You can see Uber's valuation here from its Series C through IPO. Series C was where it was valued at $4 billion. It IPO'd at $82 billion. So, pretty nice returns for earlier stage investors. Unfortunately for Uber, actually, here we have the latest market cap. It's actually below its IPO price. It's obviously run into some issues. They can turn it around. But just to give you a sense here, how really so much value is created in the private market, Actually, so far, it's actually below its IPO price in the listed space. So Xiaomi is another example. So if you look at like, from the Series A through to IPO, they went from a $300 million valuation to a $54 billion valuation. Now, Xiaomi's actually done pretty well. They're above, their IPO price. They're doing well. And so people who got in the IPO have done well. But still, you can see how so much value is being created in that private market stage. And that's because, that's also the period where they really, they had to really find their fit, find their market, and prove their value. Here's Snapchat. So Snapchat, we're not trying to say that everything's bad in the listed space. Snapchat, since it's IPO'd, has actually done very well. They've adapted extremely well in the face of COVID. They've been probably one of the most nimble social media businesses, I think, that exists right now. And they've been really leading innovation, at least for the West, in social media. But still, you can see how so much value is created in the private market. Went from $800 million valuation Series B to a $24 billion IPO. Now, I just want to make clear too that, unicorns are much different than startups. Unicorns are companies that are $1 billion, usually valuation or higher. They have validated business models, and they're normally in the course of basically, they figured out their product, they figured out their business, and it's just about scaling, and they're not, really startups. The startups, the risk profile is dramatically different. They're still trying to figure out what the exact business model is, et cetera. So what's nice about the trend we've seen in the last 10 years is that so many unicorns have come to market, and that means in the private space, we can invest in tech companies that, have at least a validated business model, and they're a little more mature than pure startups. So there's a huge difference, even though these days we kind of still call big companies startups, or but they're not really. And looking forward, the pie chart here shows where we see future unicorns, and a lot of them. And for us, it's a huge space is enterprise, FinTech, and then to a lesser extent, healthcare hardware. So these are where we think a lot of these will be created. So, I think we're all pretty aware, COVID has changed our lives, dramatically, and it's changed how we do business dramatically. Look at lockdown and social distance measures, right? I mean, work from home is just normal now. Before, it was a very unusual thing. Now you have companies with thousands of employees all working from home remotely. Now that's created huge opportunities in the tech space. Okay, and there's so many tech companies that are creating solutions to now help us manage this whole new way of working. Health and hygiene. So this health and hygiene has helped drive e-commerce, helps drive online transactions, help drive digital contactless mobile phone payments, and that's also creating a lot of opportunities in the tech space. International travel restrictions. We've been forced to find new ways to entertain ourselves. Gaming and such. Online gaming, esports has been benefiting massively from all this. And then the fourth thing is, the negative side, obviously, to COVID, which has been a tough time for a lot of us, is that it's the economic slowdown. It's really forcing companies to really think about how efficient are they really? Where can they be more efficient? Where can they use automation? Where can they use digital tools? And that's also an opportunity for a lot of tech companies. For us, where we see the biggest sort of upside, or let's say the most, you can succeed in every space, but let's say where we see the most number of opportunities will be in e-commerce, fintech, and enterprise solutions. And COVID has just created a nitro boost for this space. When you look at e-commerce, a big change that's happened is that we've been pushed off some of the things that we used to keep buying traditionally. Like, I'll give you one example, fresh foods e-commerce. It's been just booming during COVID. And before, it was one of those things that for whatever reason, by habit, we kind of still wanted to go to the supermarket and see our vegetables, fresh and buy them like that. But with COVID now, people have discovered that actually you can buy fresh, fresh produce, for example, right off the internet. And that's been a booming segment. Another big battleground now for e-commerce is in shoppertainment, social commerce, and live streaming. What's happening is that really the lines between social media and e-commerce are blurring, okay? The lines between what is a social media company and what is an e-commerce company, they're kind of going to become the same thing. And the lines between media and entertainment and also e-commerce are also blurring. And that's the next battleground. And it's really been innovated from China first. Southeast Asia has been very quick to pick up a lot of these things. And actually, in a weird way, I would say in terms of live stream e-commerce and things, it's been slower to hit North America and stuff, but it's now coming. this just showing how, China was kind of like let's say the inventor of live streaming commerce. It's now, and live streaming commerce and social commerce is now just very normal. And this shows percentage of the e-commerce population, the consumers are online. And, you can see that this year we're at about 30% are all using social buying, and live stream and social commerce type platforms. And that's expanded, continue to keep going up. Just to hit on some examples. So like Taobao Live is like basically like the original gangster in this space. They've just been like dominating, leading there. JD and Kuaishou. So there's been some really interesting things happening this year, whereby like JD is integrated directly into Kuaishou, whereby you can basically in a video you can buy JD products without having to go to a different platform. You can basically within video just buy products, and that's really the future of what's happening. And you're going to see that more and more in the US too. But it's just, they're kind of taking the cues from what's happening right now in China. Instagram Shops is an example of this. Like, I believe it's starting to roll out in pieces and it'll go wider and wider. Basically, all these products that people are basically selling on Instagram right now, it's still pretty clunky when you think about it. Like you see someone holding a product up and you have to kind of follow a link and go somewhere else and go buy it somewhere. You're going to be able to just buy it right inside Instagram. And that's going to be huge for them. WhatsApp storefront, same thing. A lot of people, they sell to their friends and things using WhatsApp. Now we have an image here. There's, you'll be able to you'll just be buying things right within your WhatsApp. You won't need to go anywhere else to complete the transaction. Snapchat's doing really amazing things like working with brands on AR. So whereby, like we show here, you'll be able to like actually see how you look with products or see products in your room. IKEA has done that before, but you'll be able to see products in your room and things like that. And then buy them immediately within Snapchat. That's the future. And Shopee has been a big, leader for live stream development in Southeast Asia. These are just some of the notable e-commerce unicorns in the region that are still private. I think we're aware of all these, but Tokopedia in Indonesia, Flipkart in India, and Xiaohongshu in China. So FinTech is another huge space that we see. And actually the adoption was already pretty strong. 64% globally, we had adopted some sort of FinTech products, according to Ernst & Young here. And we think this year that's going to change. It's going to be dramatically higher. And what's funny, the big change is that I think what we're seeing with COVID is that tech is the #1 competitive advantage of a bank or differentiator. So because we don't even want to go to a brick and mortar branch right now, or we can't, right? Because of worries about COVID and lockdowns, things like that. So really the interface on your phone, if that's better than another bank, that's a better bank. So software is becoming the key competitive edge of a bank. And the problem is that traditionally banks aren't software companies, right? So it means that tech companies now it looks like they're going to actually have the edge in banking because it's all about who has the better software interface for the customer, right? And the different features and things like that. The other big driver here is on payments because a lot of times when we're using cash or we're not using our phone to pay for things, it's just purely habit. It doesn't make sense. It's more efficient usually to use digital payments or use your phone and things like that. So COVID has forced us to kind of get off a lot of the cash, things that we were doing. And research that we've done at 01, we've found that one of the #1 drivers of e-commerce adoption and also digital banking is just moving people into digital payments. And it makes sense when you think about it. Like once you get people comfortable paying for things with their phone and having a balance on their phone of cash, then they get more comfortable having a bigger balance on the phone, right? And eventually that can be a deposit account, right? So that's how it's like getting people onto digital payments is like the on-ramp into digital banking, e-commerce, everything. And COVID has basically like pushed everyone onto that ramp. So it's a big thing for digital banking. When we look, these are just, I won't go through all these obviously, but Southeast Asia during COVID, we've seen all kinds of onboarding basically of digital payments. In Singapore, for health and safety concerns and also to make things efficient, the government's helped push and successfully done it with hawker stands with QR codes. In Malaysia, GrabPay seen boom in transactions, GCash in Philippines, booming transactions. Indonesia also, QR codes kind of like Singapore, adopted. In Thailand, interesting data point in the bottom left corner there, is that, AirPay reported 30% increase in transactions from users above the age of 50. So obviously, as we get older, all of us, it's harder for us to go, move on to newer things. COVID even forced, a lot of people to really get off old habits and get digital. Vietnam also a lot happening there. These are just some of the notable FinTech unicorns that are basically eating into banking. And I'm sure we're all well aware of, Grab and Gojek here, wanting to become digital banks. But again, this goes back to the fact that what we see is that software is going to eat the banking world basically, and like software companies will have an edge over banks, and licenses will be commodities. So enterprise solutions is another space where we see huge opportunity. And the reason is that when you think about it, before COVID, like digital remote work management was like just saved for like niche industries, usually white collar industries, usually techie industries, right? But now with COVID, there's just so many industries realizing they need some way to digitally manage their workforces remotely. Because there's, 90% of industries just didn't do it. We've just been checking in at physical workspaces and on Excel sheets and paper and things, Now everyone's realizing, wait, what, shouldn't everyone just have an app on their phone? Like if they're working at a place, can't we manage everyone with an app on their phone? So the huge lion's share of industries are now realizing they need digital solutions to manage their workers. And so it's like a huge white space created by COVID. So this is just some examples of like booming usage. Microsoft Teams, I think we barely knew about it before. And now, usage has been booming. Obviously, they were well positioned because of Microsoft Office and all that. Zoom, I've been using Zoom for years. I'm sure a lot of us have too. But I remember where people didn't know what Zoom was, and they were still using these really expensive corporate, conferencing things that cost a fortune. I would say, let's just do a Zoom call, just like a link, It's actually so easy to use it, but it just took COVID to get everyone on it. And there's other, Zoom's not alone. Obviously, there's a lot of companies that are doing similar quality products. These are just some of the unicorns that we think are helping the world transition to a remote world. So I think another big thing that we've seen during COVID is the adaptability and the speed at which a lot of tech companies have been able to move, where traditional companies haven't. And I think maybe sometimes it's culture, because tech companies are because tech's a fast moving industry, they have to move quick. So, they might, big tech companies maybe think on 3 to 6 month time scales. Small startups are like on every week something new is changing, but like traditional companies, like every 2 years something changes. So like when COVID hit, you've seen how these tech unicorns have been able to really adapt. A great example, I think, is in the travel and leisure space. Look at Airbnb is a great example. Airbnb, their entire business was basically wiped out by COVID when you think about it, But what have they done? They very quickly pivoted to this model where they're getting people to sign up for digital experiences. Now, it's still a challenge for them, and we'll see how they do. But I think the point here is that now think about what the hotel companies had to deal with. They can't do this because they're stuck with all their physical assets, right? So their whole time during COVID is, how do I keep using my physical assets, right? But Airbnb, being free of physical assets and basically being a community they have tons of users digitally, they could just say, okay, what else can we shift our digital users into and still fulfill certain needs and things like that. So it's just an example how a tech company can move much quicker. And when you're tied down by all these physical assets, you just can't do things the way that a lean company or a nimble company can. And Klook's another example more locally that's done something similar. And these are some, I'll just skip over. These are just Airbnb, Traveloka's done similar things. Klook's done similar things. Ride hailing, also pretty dramatic pivots. Again, traditional taking riders around has been wiped out, but obviously e-commerce demand has been booming, food demand has been booming, and so ride hailing around the world has generally been very successful, pivoting into food delivery. Grab and Gojek have been reporting or are having huge demand in huge jumps in demand in their delivery services. And when you think about it, again, they're just logistics companies. Whether they're delivering people around or delivering food or packages, it all plays to their strengths. So this is where I'll start to end, and we'll kind of end on the concept of when you're looking at unicorns, what is there to consider? Now, it's it's different than with like when you're looking at listed companies in the stock market, because listed companies in the stock market, there are all kinds of disclosures and there's a lot of financials. They're more mature generally, so it's a very different process as unicorns. So I think one thing to look at is the industry dynamics, and it's basically like a big part of I think the success of a company. It's really thinking about where does this company's solution fit in the ecosystem of other companies that are out there, and where do they have competitive edges, and are they, a lot of times I think are they in a business where now software is going to just like, outcompete traditional industries? And like when I go back to that FinTech example, it's a great example. Like, are they in a space where actually they're not really competing with the other tech companies so much as just going and like more efficiently and doing, better serving customers in some industry that's now digitizing, So I think that's one thing to consider. The other one is the super app versus focus strategy. I think both have their merits, okay? The super app, obviously there's economies of scale. There's a lot of things you can do with multiple, a Grab, for example, has been able to they have a massive user base. So as when they pivot, they can kind of just pivot their user base into new products, right? That's an advantage. But focus can be good too, because, for some things that we do use tech for, a hyper focused player who's really optimized to exactly what we want to do with that app can be actually more successful than something that's trying to be everything to us, because it's simpler and a more streamlined experience to go use with them. The third thing is, unfair advantages, obviously. I think probably people know this, but, I think finding those companies that just have have just created massive moats. I think that's a huge thing to look for. Management team. So in earlier stage companies, even still unicorns, I think the management is way more important than in a listed space, for example. Listed companies, they become, a lot of times really big companies, they become kind of machines, right? So even if the top changes, I mean, the whole thing can keep kind of going. But earlier stage companies, even unicorns, the management's really important. And I think most important thing is in the management's decision on what to focus on, and what to do at pivot points, like Airbnb being an example. Netflix is a great example. Netflix has been able to pivot and evolve with, Netflix started by doing mail order, movies. And when you think about it, the internet should have annihilated them, right? Because streaming, you don't need mail order, but they were just always one step ahead. And that's where I think the management was been very, very forward looking, So I think management's very important, in the unicorn space. Financial performance. Now, this is an interesting one because we don't get a lot of disclosure from unicorns because they're not required to, not required to put out major disclosures. So you have to kind of work with, piecemeal information. It's not like in the listed space. But I think you can still, obviously, you can still consider that. And I guess the most important thing, I think, in a simple way, is you want to see significant growth because as long as a business is growing, there's something there. When a tech business stops growing, sometimes it's a real problem. It's rare they stop growing and then just start growing really fast again. Usually it's they just keep growing, but if there's a major stop, it might be something wrong with where they are in the industry, and they have to really change something big time, or it could be a problem. Key investors and partners, again, much more important in unicorns than compared to traditional listed securities. When you have big, investors behind you, it means they have more ability to raise capital in the future. Also, they have strategic relationships. They have strategic investors. They can build their business better. So that's where it's very different than listed companies. And then finally, I think, especially in tech space, it's the IPO and acquisition potential. And that's because in today's world, when you think about it, we have these $500 billion, $1 trillion plus tech companies. And they are kind of, they're in this battle for long-term, positioning. And if a smaller unicorn can kind of capture some new space in the tech industry as it's evolving, and if that piece is the missing puzzle piece that Google needs, or the missing puzzle piece that Apple needs, or Tencent, there's a very high chance that it's really valuable as an acquisition to them. And a lot of these can be bought up at acquisitions. And even if they're not bought as an acquisition, it's a nice backstop, they can always kind of shop themselves. So I think if you can see how one of these companies can be really valuable to one of the really mega tech companies, then there's it helps protect the downside, that there's a good chance at worst case, someone can come in and just buy this thing out, and usually they buy it out at some premium. So these are the 7 main factors. With that, I'll stop there and we can go into the Q&A.
Great. Thanks, Vincent. That was fantastic.
Sure.
I have a few questions before we open up the Q&A. Let's talk a bit about what's happening in the public markets, right? I mean, the US markets until sort of the last week or so have actually done really well. In the last 6 months, they were up, 30+%, right? So, the question for investors out there, I mean, where should we focus on? Should we just sort of focus on the public markets for now and just leave private markets? What's your view on that?
Yeah, I mean, Look, I think what I'm seeing and what I'm hearing is that, obviously it's great that public markets have done well. And it's kind of strange at some point to a lot of people because actually the economy is kind of on the down, right, because of COVID, but the market's done really well, especially in the US. And a big driver is that the market in the US is very tech heavy, and tech has actually been shining in this whole crisis. I mean, imagine if this had happened and we didn't have the internet or all these services, it would be a lot harder. So tech's really shining, and there's some reason for how well they're doing. Having said that, I think there is awareness that now how far can this go? And I actually think that there's going to be a reallocation, from the listed stuff that's done very well and looking for more private opportunities. So basically at a larger scale for investors or, large like pension funds, things like that, reallocating out of public and into private equity funds, VC funds, all things like that, which will put capital over there, or maybe they feel like they can kind of negotiate their own valuations. They don't just take what's in the market.
Well, I guess also a strong public markets bodes well for any exit at the moment. There seems to be a huge vote for public market exits. Well, going on to the next one, I mean, what do you think is the one trend that will continue to boost or benefit tech companies, even post-COVID, right? I mean, we talk about COVID really boosting or as you said, pushing them up the ramp. But what do you think, that you see post-COVID that will continue to, make this or have tech companies be the focus of investments?
Yeah, so I think there's this old internet bubble quote, I think Mark Andreessen, something like software is eating the world or will eat the world or something like that. I think, but it's very apt because I think the trend that doesn't change is that it's almost like, more and more industries become software industries, essentially. So software used to be this really niche thing. And now more and more industries, it's almost like if there isn't software, it's like you're not really doing your business properly. So I think one thing that doesn't change is that software just expands and it starts becoming the key competitive advantage in newer or more and more industries. And eventually it's almost like every industry, if it doesn't have a software edge, you're not going to make it, So I think that's an interesting space always to look at is where is the latest traditional industry that's now going to be eaten by software? For me, I was saying, I'm a big believer, it's digital banking, but I think looking for where that is, and that never changes because it's software just expands, the cost of it reduces, there's more innovation. So new use cases software is used for to go digitize things that we did traditionally without it.
Yeah, well, I mean, with that, I mean, does that and perhaps you can comment on this, what we saw and again, you mentioned this, is that technology companies actually very quickly pivoted during this pandemic. And do you, obviously, what are your observations around that, further observations around that? Again, it's presumably a confluence of software, but also are there other things that are at play here for companies to very quickly pivot?
Yeah, I mean, I think this whole situation has really, I think, force companies to just to rethink everything. And ultimately, traditionally, tech companies have been the ones that have just been really fast moving, but there's no reason why traditional companies can become fast moving. So I think it's just that the business cycle has accelerated for a lot of industries where before they didn't have such a fast business cycle. So I think it's just a matter of who can adapt to that. But I think it'll persist. I think once you change these things, I think it won't be companies will suddenly, undigitize themselves and slow down their cycles again. I think it's kind of force a lot of industries to really think hard about what they're actually doing. Yeah.
Well, I'm going to move on to a sort of very interesting question around valuation, right? Because, a lot of investors, at least the ones I see in Asia, tend to be very conservative, and we're also sort of very focused on earnings metrics, right? Mm-hmm. And a lot of these unicorns, I mean, even as they are unicorns, are actually not breaking even at the net profit level. Yeah. So, an earnings metric seems to be sort of quite irrelevant in this debate, but I'd love to hear from your experience. How do you think about valuation, about growth companies and unicorns in particular?
Yeah. Yeah, I think so. Yeah, there's to me, there's two types of like high valuations. Okay. There's like the high valuations that are just hyped up and crazy. Okay. So we can like, those definitely exist. And that's definitely something to watch out for. But I think there's another type of high valuation that it looks high, but it might be because you're using the wrong metric to come to look at it with. And I think we have to always, and I think there's a lot of, sometimes it's too easy to say, oh, that company's crazy. Like it's high, it's so expensive or it makes no profit. And we have to realize, there's a lot of smart money out there. And there's a lot of people thinking really hard. And there might be a reason why. There might be that we're looking at it the wrong way because accounting, when you think about it, it doesn't account for everything that actually builds value in a business. There's a lot of, especially in tech world, there's a lot of soft things that don't show up on balance sheets and that you can't like capitalize. So you have to just expense it immediately, even though actually you're building long-term advantages. And I think like a company like Amazon kind of is a great example of it. For a long, long time, people just said Amazon's crazy, and they said like it's not making any money or it's not making cash flow, and it's like on the traditional metrics it looked too expensive. It's looked too expensive for like 15 years, but it's just gotten bigger and bigger and bigger. And there was a certain point where people realized, oh my gosh, like they built this like competitive moat that almost like nobody can beat now. And what people now realize, it's easy for me to say all this now, to be honest, but when you look back, you can see, wait a second, like they were just spending a lot of money operationally, which was making them show very little income, but that spend was building long-term advantages. So it's different than whereby in traditional businesses, accounting lets you like buy machinery and you don't have to you can like make it CapEx and it doesn't count against your earnings, because accounting was designed for that, but like accounting doesn't always attribute like a lot of the long-term value that's being built in a tech company. So I think you shouldn't automatically write off when it's not making money. It may be that they're purposely, like Amazon, if they wanted to, they probably could have shown some profit way back, but they realized, like, do you want to build a business that nobody can ever beat again, or do you want to show some profit 10 years ago but still be open to competition? So they were very clever on that. So I think yeah, there's two types. Another great example of this is I think WhatsApp. I think maybe people remember that when Facebook bought WhatsApp, I think it was like $19 billion. It was like a tiny company. People thought it was completely ridiculous. They thought it was stupid. But when you look at where the world is today, imagine if Facebook didn't have WhatsApp. Imagine if it didn't have Instagram. Facebook would be in deep trouble when you think about it. The core Facebook is actually kind of like, it's kind of behind, right? But luckily, they bought these things. And even the price they paid for WhatsApp has been more than worth it for them. Because again, you have to think about what is value, and value can be different things. So Facebook didn't care if a company was earning, $100 million back then, because it already had money. Wasn't the problem. Its problem was that Facebook actually missed the mobile social media trend. Yeah, so Facebook was great on the desktop, and then they realized they missed something, and it was really important, and it was really hard for them to catch up. And so WhatsApp was their solution, and it allowed them. They knew they know how to make money once they have the platform and all the people. They can figure out how to make money. So they don't need WhatsApp to make money when they buy it. But WhatsApp solved a problem that was a huge strategic problem for them, and that's why it was worth so much to them. And again, when you think back to it, if they didn't, and Instagram also, but they bought way cheaper, but I think it's $1 billion. But if they hadn't done those two moves, Facebook would be in trouble right now. They wouldn't be where they are now. And so when you think about it, Zuckerberg has actually been very, very forward-looking and very clever, and to pay those prices for these things. And everyone thought he was crazy. In retrospect, they were great moves.
Mm-hmm. Great. And I'm sure we'll have a lot of questions during the Q&A about that, right? Because the valuation is such a fascinating topic. But before I, let other people have the questions, my last question for you is, there's been so much talk about what's happening between China and US, and that is sort of obviously spilling over into the tech scene and what's happening with TikTok. What's your view on how the China-US tensions will impact tech companies both ways, both in the US and in China?
Yeah, I think it's definitely now. Obviously, there's a lot of politics at play, and the Trump administration probably has, obviously, is kind of pushing a lot of things. But I do think this concern will persist, even if there's a change in the presidency in the U.S. I think there's a growing just concern in the U.S. and Europe and maybe other countries about, or India too, of just how, the sort of the Chinese model of having the companies really, really close to government, and at least a perception is there that there's just concern. And so I think it's going to continue, and it kind of clips the global ambitions of Chinese companies, frank. And it's gonna hurt them in that sense. Luckily, China is a huge market for them, so they can still do a lot in China. China's a mega market, so they can still become really big there. And Southeast Asia is still, I think, very much open, and they've been very early in Southeast Asia, and I think they're going to dominate in Southeast Asia. So they still have Southeast Asia, and they probably have other parts of the world, Middle East and Africa and South America. But yeah, it does clip their global ambitions. I mean, ByteDance was on track to be like the first really successful global Chinese tech company, and this issue basically clipped it. So it's definitely it's going to reduce their total potential for now, but they have so much they can do in the next 10 years. They'll be fine.
Great. Well, hopefully some of that spills out to Singapore, right? We can see.
I think that lots coming to Singapore. Yeah.
So before we go on to the Q&A session, we have a number of questions from the audience. I think we're running two poll questions before we start the Q&A. So give everyone a little bit of a break, but also please answer the poll questions that's coming up. And again, while you're doing the poll, I just want to sort of remind everyone that you have your question. Please click the Q&A button right at the bottom of the Zoom screen and post your question away. We will try and answer as many as we can within this session.
Yeah, I voted early stage too, so you know.
We have some risk-taking appetite in this.
The fun stage.
Okay, shall we start our Q&A? Here we go, the poll results. VC funds, we definitely have some risk takers in this room. Unicorn startup, so that's great. All right, let's move on to our Q&A. We have a number of questions to get through. First couple of questions I think relate to valuation. I know we talked about profit before, but if you sort of think maybe Amazon managed to raise capital and keep going without making money, but even companies like Palantir and C Group, and the Palantir CEO basically saying they may never be profitable, but yet they're looking to do an IPO quite shortly. Yeah. I mean, how do you think about that, right? The unprofitable CEOs basically saying that they might never be profitable, and yet they're worth billions and they're out to do an IPO.
Yeah, again, I think it's thinking about, look, it depends on obviously the company, the industry, and the situation. But value isn't always profit. It really isn't, because especially in the tech space where there is an acquisition potential where you solve a key problem for a company. Okay. And so there's real value in that, because like very large companies that already generate lots of profit and cash, their biggest problem isn't, oh, how do I make another 5% more profit or 10% profit? Their bigger problem is, how do I future-proof my business in this rapidly changing industry for the next 5 to 10 years? Like if you solve that problem for them, you're worth a ton. Okay, so that's where you may not be profitable, but you've grabbed that position, and like the way that WhatsApp grabbed that position for Facebook. WhatsApp could have been making $300 million, $500 million. If they didn't have that position that Facebook needed, they wouldn't be worth anywhere near what they paid for it. So I think you have to also look at where does it fit in terms of what is it valued to the industry, and that's a huge thing in this space. So I would say that's what you have to look for. But of course, there's also stupid valuations. So I'm not defending all the valuations out there. And at some point, especially if you are worried about raising capital, yeah, you need to find a sustainable business model, obviously, at some point.
Great. Okay, next question. What are some of the major trends to look out for that would make or break a unicorn? For example, Airbnb.
Yeah, I think it is the leadership. If we're talking about like breaking a unicorn, or I would say if you see like you think they've taken a massive wrong turn, I think I think that can be a major problem for a unicorn in terms of like trying to pivot into something. And I'll readily, let me discuss one thing where I was wrong, and I thought it was a huge mistake. Like, and in the end, they did okay. Like Snapchat that we showed earlier, a couple years ago, they started developing these AR glasses that they still have, and they're still developing. And they thought they're going to get everyone to wear these glasses, and they're going to be, Snapchatting using their glasses. And I thought they looked pretty dumb, and actually they didn't take up very well. And they spent a ton of money on it. And then there was one point I was like, you know what? I think this is like just bad decision making. Now, somehow, I don't think they're still doing that great, those glasses, but they've kind of managed their way through it, and they've on other sides been able to do really well. And I was actually proven wrong. Let's say they're not doing, Snapchat's doing better than ever right now, despite that early, what I thought was a mistake. But I think if you see a major mistake in direction, that can be a real problem, for business. Yeah, so I think it's that will really break a business for me, or just like crazy out of control spending. Yeah, I mean, again, I'm all for spending if it's building long-term advantages, but if it's I think some companies, when they're growing really quickly and there's like a laziness and they're just spending money like crazy without really thinking about expenses. And when the money tap, when the money, capital raising, money tap stops, they're caught, so yeah, that's the other thing.
But that is company specific, right? Those are very company specific issue, management related issues.
Yeah.
And I suppose the question is by definition a unicorn actually quite wedged into their sector or in the right direction, such that it's quite the sector is not going to sectorally shift away from the unicorn, right? And usually it is maybe a misstep or two by the management team, or a misread of a situation.
Yeah, I think that the thing is that things change quickly. So and another thing to look at is sometimes unicorns are, so one is that things change quickly. So even if they're doing well now, I think this is where the management is really important in these companies, because like 2-3 year view, things can change dramatically, and companies that are doing really well can suddenly do badly if they didn't focus on what they do, and do best. A big problem, a lot of companies, especially once they raise tons of money, they kind of spend it on like too many things, and they don't stay focused on the core, that like different, the core value that they deliver. So that could be one thing. Yeah. But yeah, I think those, that's, so I think it's still something to look out for, is that really, are they, if you think they're making a big mistake and what they're doing, are missing something, it's because you have no ability to change their direction, and they may not realize it for 3 to 5 years.
So which specific unicorns are you watching closely, and why?
I think well, in this part of the world, I mean, definitely, I think Grab and Gojek, really interesting. Because it just I mean, I'm still interested to see how this whole super app status evolves in Southeast Asia. I'm still of two camps, to be honest. Like I'm like a pretty big believer in like really focused tech companies that just don't over diversify, but I have to admit it's working really well for Grab and Gojek. So I'm curious to see how that all plays out. In the and then the other one is, I guess, I'm really interested on the digital banking space. Yeah, and just seeing just in different parts of the world. It's it's actually listed, but it's Square in the U.S. And like in this COVID situation, they've just transformed into like a digital bank very rapidly. So I think there's an opportunity for a lot of FinTech businesses, even in the private space, to very quickly become digital banks if they want to be. So I think that's another interesting space to look at.
There is an interesting question here. For every WhatsApp, there is a WeWork, right? And even the case of Theranos is quite interesting. And I know we talked about a few mistakes, but what do you think? Where would you have read some of the signals in, let's say, a WeWork?
Yeah, definitely. I mean, you're right. It's a good point. I mean, I don't want to defend, like some of the ridiculousness that's been out there. I think it's like thinking about like, is this really like, I never understood where WeWork was actually a tech company. You know what I mean? Like, it seemed to me just like an office renter that was like, renting on one term and then like re-rent, subletting it out at like a very short term, basically, to other people, at a profit. Like, so I think that's one thing, is really think about like, is it really a tech company, or is it something else dressed up with a high valuation and they make it a tech company? Like they create a tech story so that it gets the valuation, but actually it's not really like a tech company. So I think that's what I saw, I think, with WeWork. And I think another thing to look at is that when you see the round valuations, look at who's investing. Okay, so for example, like they're like sometimes like the valuation and the amount that was invested, because sometimes like the latest round is actually just like one of the shareholders maybe putting not that much money, and so they put it maybe purposely at like a high valuation so it looks like it goes up, but actually it's kind of like to like save their own butt in a way. So I think also, or you might just think that the people who invested at that level, maybe you just don't respect them. You don't think they made the right choice. So I think also looking at the type of money that's buying, at a valuation is important. I think so. There definitely, I mean, you have to be on the lookout for those things. I think those are the two main things. Is it really a tech company, or is it just like a business dressed up with tech to give it a high valuation? And is that valuation like, do you think that the people who've given it that valuation are like, do you respect that they know what they're doing?
Yeah. Well, I all kind of say it sort of hindsight is 2020, right? I mean,
of course.
When WeWork was going nuts, everyone was like, "Oh, wow."
Yeah. I mean, I love WeWork spaces. They're nice spaces. Yeah.
What's your view on air wallets and the payments market in Asia? How do you see payments market changing over the next 5 years? I mean, personally, when I look at Asia, we're actually sort of so non-homogeneous, right? Can we as a region actually compete with the US, which is obviously a lot easier market to talk about payments or execute payments?
Yeah. What's funny is that when it comes to mobile banking, mobile payments, one of the biggest hurdles and impediments is just our habits and our tradition. So what's been found in a lot of developing markets, even places like Africa, is that like people who've never been exposed to, for example, let's say if they've never had a brick and mortar bank account, they're more likely to accept using their phone as their bank. Whereas people in developed markets where they just feel like a bank needs to have some physical presence that they feel comfortable walking into, and like they've been slower to adopt a lot of things. So actually people in newer markets can actually leapfrog and in terms of adoption. And we've actually seen that with payments, like, and especially in e-commerce, like China probably is in China, like I think South Korea are some of like the highest in terms of like digital payments. I mean, in China now, you look like an idiot if you pull out cash, basically. And I don't even like, you can barely use it anymore. And it's like, and it's funny because you think, wait a second, aren't a lot of these people coming from like a less, China obviously is a huge chunk of it's fully developed, but there's also still a lot that isn't, right? But it's actually because, these people are just rapidly developed, right? The economy's rapidly changed, their lives rapidly changed. They're ready to just try new things very quickly. Whereas convincing, people that have just been using traditional banks and cash for traditional payments for so long in Europe or US, it's actually harder to shift them to these things. So I think Southeast Asia has actually been, it can leapfrog quite a bit. It hasn't moved as quick as China, but why I think Southeast Asia now is going to really have a huge uptick in removing cash is that, of course, COVID, that's been a big thing, but the other one is that the Chinese companies, as we said before, the big Chinese tech companies, they're all here and they're all driving their businesses. And again, the research we've done is that the number one way to drive digital growth in e-commerce and banking and all the stuff that the tech companies want us to be doing is to first get us onto that on-ramp, which is mobile payment. Okay, so if you look at in China, if you look at the graph of e-commerce penetration, basically people shifting, brick and mortar to e-commerce, and you look at the graph of mobile payments, you see that once mobile payments take off, e-commerce just goes like that. So the companies, I'm pretty sure we're not alone in knowing that. We've studied their Chinese companies that see it. They know that too. And that's why in Southeast Asia, there's going to be a huge push already is to get people using mobile payments. And it's kind of like they're going to take the playbook they did in China and they're doing it here. And that's why I think we're going to see a lot happening. And it's already starting in Southeast Asia in the next couple of years.
Yeah. Great. Well, moving on to sort of the slightly more, personally invested question. There's a question from the audience. I understand that all these pre-IPO processes, that private unicorns basically go straight to large institutions, right? Like GIC, via the investment banks. How can private investors, especially those who are participating tonight, how did they get exposure other than buying a bank stock or a tech ETF or any sort of other ways out there besides coming to iSTOX?
Yeah, I mean, I think look, there's some really valid reasons why like individuals just can't partake, in later stages, because you just can't have that many. I mean, you have to simplify your shareholder structure and everything, in a traditional state. So normally the best chance to get into a lot of tech companies for an individual is at the early stage. There's a certain point where it'll be very hard for individuals to get in because funds will just take up the whole thing, and they want to try to minimize the number of entities that invest at any moment, in any round. So yeah, it's hard as an individual later. The best way really is if you want to be in those later stages is via funds, being part of funds that are investing into the companies. Now, I mean, it's a nascent industry, but with what's happened with blockchain and digital securities, there are a lot of players now that are trying to make it easier to create markets in these private companies, and so that could change things as we go, and make it easier for smaller investors to partake in these like mega rounds in later stage private unicorns. But yeah, traditionally, the only way is really through you have to be in a VC funds or private equity funds, because they just, even if you had a significant chunk of money, they just won't take you because it's just too late. They can't take small investors.
Yeah. So if I could, just add on to that from my previous experience, even at the private bank, there are some private banks that obviously can aggregate some demand for some of these unicorns, but even then, it is actually only presumably available if you obviously are a very ultra high net worth investor. And also I think the other sort of opportunities in the market tend to be either secondary funds or VC funds, right? But those you kind of have to get in early and hold for a relatively long amount of time. Obviously for someone like iSTOX, as you mentioned, the ability to digitize and fractionalize some of these funds actually make this quite an interesting entry point for, I think, high net worth investors who are not necessarily at the level that you're getting that kind of attention from your private bank or get that kind of access yet. So I think it's a little bit advertisement for us to say, watch the space.
Yeah. No, I think it's interesting. And there's a lot, I think you can be done, especially for like, as you mentioned, like traditionally, for a private equity or VC fund, there's like a really long holding period. You have to wait till the fund, completes all its investments, liquidates, and gives your money back in 7 to 10 years. It's like a long time to wait. And so when you put money in, it's just going to sit there. But the nice thing with blockchain and stuff is that there are a lot of companies working on solutions that will allow people to, sell their interest in a fund without having to wait till the end. And that's and do it efficiently at a cost-effective manner, thanks to digitization. So yeah, it's an interesting space that's growing.
Yeah. Another markets question, and this is obviously since we talked about how the U.S. market has gone up significantly, it's actually also sold off in the past week or so, and that seems to be largely driven by tech. Any observations on that? Is it related to SoftBank's Nasdaq whale saga, or do you think that between TikTok and what's happening in or what's happening in the US is a very political sort of shift driven move or sell off?
Yeah. No, I think it's there's been a lot of like I don't want to be I guess I don't want to be too political, but I guess like in the US, people are starting to be there's a lot of obviously like political clashes and stuff, and I think I think that's the market's really worried around that, and I think also we've seen COVID resurging in a lot of places, and I think places where they thought they got it under control, it's now resurging, and that's creating a lot of questions. Especially because the economy's already been hit, and I think these are two factors. And then the third factor I think we're just starting to see is that the COVID slowdown impact is a bit lagged. So because what happened is that COVID hit, right? We have all these lockdowns and companies are forced to freeze, and a lot of business activity freezes. Now, the first stuff to go is like the small businesses, basically. Tons of them basically have been hurt really badly, and like their workers are let go and such, but bigger companies, they can actually bear it a bit longer. And also a lot of companies, when they're really big companies, they kind of want to, support the country too. They can't just start firing thousands of people the second COVID hits, right? So they kind of they could bear it. They have balance sheets, they have bigger businesses. They can kind of take the pain for a bit, but they can only take it for so long. And I think what we're starting to see now is you see some really big companies that are starting to let people go. And they couldn't do it immediately, and they tried to take the pain and do their part to try to keep people employed, but there's a limit, right, for a lot of these even bigger companies, and then they start letting go, and especially the white collar workers start losing their jobs, and that's when it starts really hitting that something's wrong. So I think that's what we're seeing too happening, is that it's like the lagged effect of COVID really starting to hit the economy.
Wow. Well, let's see how the next couple of quarters play out, right? Because results season sort of around the corner. That I think will signal quite a few things.
Yeah, I just like to add that in the private space and in the tech space in particular, I mean, it's like one of those like well-worn business concepts that like in business you should solve people's problems. Like they always say that, Now think about it. There's a lot of problems in this COVID world. So in theory, there's a lot of business opportunities. So I think that's the way to look at it. And if you look in the tech space and even what we've been doing and looking at, we've seen a lot of tech companies booming right now, and they're booming for good reasons. They're helping us get through this crazy situation. So, from a top level, yeah, the economy is going to be slowing down and things, but within it and within tech, actually, there's a ton of problems now that need solving. So business, it doesn't mean that there aren't business opportunities. There's tons of business opportunities now. It's almost, there's a lot more maybe, if you're, a tech business and you're smaller and you can see where the problem is and go solve that problem. So I think that's like the optimistic way as a business person to look at it all.
So we'll probably just cover one more question. I was going to ask you, you have the benefit of a lot of research. And, when you look at the life cycle of a company, you're probably a lot more advantaged in terms of, understanding or taking a view on the position of a younger startup company versus a unicorn, right? Do you think that for someone who's less or doesn't have the same amount or access to research as you do, when a person wants to get access and let's say has the opportunity to get access between a young startup company and a unicorn, I mean, on balance, what would be your advice to these investors?
I mean, if they don't have access to, they feel like they don't have enough access to.
Yeah, they're not say it's as well researched, or they're just coming in relatively new to the private market game, right?
Yeah, I think there's two things. So the earlier stage of the company, the more important the leadership is. Yeah, so I think that's one thing. So if you, and I think sometimes we can, we can all be a judge of that, So I think that ultimately, like, yeah, it's, and you can have a mediocre business, but if you have the right people leading it, it will succeed. And you could have the best business ever, the wrong people leading it, it'll die. So I think that's the first thing that we can all do on our own, And then the other one is that I would say just look at who else is backing a company, and if you respect those investors, because they're basically you're basically jumping on you're along for the ride with them, and if you think that they're going to be able to, even if the company's in trouble, kind of help that company through the situation, and you value them, then that's another way you can ride on their other the other thing. But obviously not every big company means they're automatically smart, but I think it's just something to think about. Yeah, if you think that, okay, those guys are pretty smart and they're in this company and they're think they'll through thick and thin, they're probably going to be able to push this. And I think that the management's really strong, and even when things go wrong, even if they make some mistakes, like I just think those guys are hard to beat. Then I think that's one way to do it if you feel you don't have other information.
Great. Well, thank you for this great session, Vincent, and spending the whole evening with us. I hope everyone found this educational and interesting. And again, Vincent and our collaborative report will be out on our website shortly. If you'd like to get access to that, drop us a note at media@iSTOX.com. So that's media@iSTOX.com. Or reach out to any of us, via the chat or otherwise. I would love to thank Vincent for this time, and I would like to also, Vincent, if you don't mind letting me share my screen.
Yeah, sure.
I have a little bit of an advertisement for our next webinar, which is next week. We are presenting something completely different from tech, and we've gone from unicorns to real estate. As many of you would be exposed to real estate in the listed space, we know a lot of it has been a massive disaster in the last couple of months. We have Manish from Straits Investment Management to talk about his views on building a real estate portfolio and what might be some of the COVID impact to traditional real estate. So thank you everyone for joining us this evening. We look forward to seeing you next week. Thank you.
Thank you for your time. Thank you.
Thank you. Thank you, everyone. Good night.